Okay, so you want to own a 5-star hotel. Marble floors, a lobby that smells like eucalyptus and money, a rooftop pool overlooking the skyline, and a doorman who knows your name. You picture yourself checking the occupancy report from a corner suite, sipping coffee while someone else makes the beds. That's the fantasy. That's what the brochure sells you. Here's what the brochure doesn't show you. The $2 million per key construction bill before you've sold a single room night. The franchise company that takes a cut of your revenue whether you make a profit or not. The property improvement plan that forces you to spend 7 figures on new carpet and lighting fixtures you didn't ask for. And the fact that the actual hotel rooms, the thing everyone assumes is the business, are barely where the real money gets made or lost. Owning a luxury hotel is one of the most misunderstood investments in America. From the outside, it looks like glamour. From the inside, it looks like a low-margin, high-fixed-cost operation where your single biggest expense, labor, rises every year, your revenue depends on strangers deciding to travel, and one recession can wipe out 3 years of profit in a single quarter. Some luxury hotels genuinely make their owners wealthy. Some quietly bleed them dry while looking spectacular on Instagram. And some exist for reasons that have almost nothing to do with hotel operations at all. By the end of this, you'll understand exactly which kind you're likely to buy, and why the smartest owners in this business stopped thinking of themselves as innkeepers a long time ago. Before we talk numbers, we need to define what owning a hotel actually means, because that phrase covers at least 4 completely different businesses. There's the franchised hotel, where you own the real estate and operations, but you're renting a famous name, a reservation system, and a loyalty program from a company like Marriott or Hilton. There's the independently branded luxury property, where you build your own reputation from scratch with no corporate safety net. There's the management contract model, where you own the building, but a third-party operator runs the day-to-day for a fee. And there's the branded residence hybrid, where a chunk of the property is actually condos sold to individual buyers who just happen to live inside a hotel. These are not the same business. A franchised Marriott in a suburban business park and an independent boutique hotel in the hill country of Texas might both wear the label luxury, but their cost structures, their risk profiles, and their paths to profit look almost nothing alike. This script focuses primarily on the franchised luxury hotel, the model most new owners actually buy into, while showing you exactly where the other structures fit into the picture. The number that sounds big, but gets bigger. The largest single cost of owning a luxury hotel isn't the staff and it isn't the furniture. It's construction. And depending on the market, that number ranges from expensive to almost unbelievable. According to the HVS 2025 U.S. Hotel Development Cost Survey, the median development cost for a luxury hotel in America is now just over $1 million per key. And a meaningful share of projects are landing well above $2 million per key once land, design, and financing are included. That's not the price of the hotel. That's the price of a single room. Compare that to a limited service hotel, where the median cost per key sits around $167,000. The luxury segment costs roughly 6 times more to build per room than a Hampton Inn, and it earns nowhere near 6 times the revenue. Industry consultants use a simple rule of thumb to check if a luxury project even makes financial sense. If it costs $1 million per key to build, you need a room rate approaching $1,000 a night just to make the math work at a healthy occupancy. As of late 2025, the actual national average daily rate for luxury hotels was around $394. That's a real gap. It's the reason so few new luxury hotels are actually breaking ground right now compared to any other category. Say you're building a 200-room luxury property at the median cost. That's over $200 million in development cost before a single guest checks in. Land alone, in a market like Aspen or Napa or South Beach, can eat a quarter of that entire budget on its own. You built it, you opened the doors. You think you own a hotel. What you actually own is a very expensive building with a brand name license attached to it. And that license is not free. This is the part that blindsides a lot of new owners. Because franchise fees are not one fee, they're a stack of them. And they hit you every single month, whether you're full or empty. First, the royalty fee. According to industry franchise fee guides, royalty fees typically run between 4 and 6% of gross room revenue, paid straight to the franchisor for the right to use their name and reservation system. Second, the marketing and advertising fee, another 1 to 5% of room revenue, funding a national ad campaign you have no control over. Third, the reservation system fee, which can run several percent more depending on how many bookings flow through the brand's app and website. Fourth, and this is the one that's growing fastest, the guest loyalty program fee. According to CBRE Hotels research, loyalty program payments now make up over 33% of total franchise-related fees at luxury and upper upscale hotels, by far the largest share of any chain scale. Add it all up, and total franchise-related fees at branded hotels commonly land somewhere between 9 and 14% of your total room revenue every single year for the life of the agreement. And then there's the Property Improvement Plan, the PIP. Every 5 to 7 years, the franchisor sends an inspector through your hotel with a checklist. And that checklist is not a suggestion. New mattresses, new carpet, new lobby furniture, new bathroom fixtures, sometimes a full renovation of the restaurant. On a luxury property, a PIP can easily run $15,000 to $40,000 per room. On a 200-room hotel, that's a $3 to $8 million bill that arrives roughly once a decade, whether you budgeted for it or not. Here's the retention hook, the thing most people never realize about luxury hotels. The money doesn't come from the rooms. Rooms are the loss leader that gets people through the door. According to industry TRevPAR data, total revenue per available room includes far more than the nightly rate. And at a full-service luxury property, food and beverage, banquet space, weddings, corporate events, spa services, and yes, the bar routinely make up a massive share of total revenue and an even larger share of total profit margin, because the marginal cost of pouring a $14 cocktail is a fraction of its price. A single corporate conference booking with room blocks, catered meals, and banquet hall rental can generate more profit in one weekend than 2 weeks of ordinary room bookings combined. A wedding with 200 guests, an open bar, and a plated dinner can clear 6 figures in a single Saturday. This is why the luxury hotels that actually make real money are not the ones with the best rooms. They're the ones with the best ballroom calendar and the busiest bar. Owners who only think about occupancy and average daily rate are missing more than half of where the profit actually lives. Now the bills that arrive every single day. According to CBRE's 2025 Hotel Operating Cost Analysis, industry-wide gross operating profit margins were sitting around 38% in the third quarter of 2025. That sounds healthy, until you remember that's before ownership costs, debt service, insurance, and property taxes get layered on top. According to hospitality research group EHL Insights, once those ownership costs are included, net margins across the industry compress down to somewhere around 8 to 10%. For full-service luxury properties specifically, a gross operating profit margin in the 25 to 30% range is considered healthy, well below the 40+% margins limited service hotels can hit, because luxury properties run more departments, more staff, and more overhead per available room, and labor is the single biggest line item on that expense sheet. According to STR data, labor cost margins reached roughly 34% of total revenue in 2024, and hotels were paying over 22% more in labor costs than they were before the pandemic for fewer total hours worked. A luxury property runs multiple restaurants, 24-hour room service, a spa staff, a banquet team, a concierge desk, valet, housekeeping on every shift, and a sales team chasing weddings and corporate contracts. None of those positions are optional, and none of them get cheaper when a slow month hits. And that's the structural problem sitting at the center of this entire business. Your costs are fixed and relentless. Your revenue is fragile and seasonal. According to national data from HotelData.com, the average hotel RevPAR across the U.S. was around $116 per available room over the past year. But that average hides massive swings by season, by region, and by what's happening in the broader economy. A hotel doesn't get to choose when demand disappears. A recession, a corporate travel freeze, a bad wildfire season, a pandemic? Any of these can cut occupancy in half within weeks, while your mortgage payment, your franchise fees, and your payroll do not go on pause. This is exactly what happened across the entire American hotel industry in 2020, when occupancy at luxury and upper upscale properties collapsed by more than 60% almost overnight, while franchise agreements, property taxes, and debt covenants kept running on the same schedule as before. Owners who had cash reserves survived. Owners who were leveraged to the edge on the assumption that good years would continue forever did not. Here's something that should puzzle you, given everything you've just heard. If the operating math is this thin, why do sovereign wealth funds and billionaire investors keep paying record prices for trophy luxury hotels? Qatar's sovereign wealth fund owns New York's Plaza Hotel. Middle Eastern and Asian investment funds have poured billions into landmark properties in Manhattan, London, and Los Angeles over the past decade. These buyers are not doing the math we just walked through and concluding it pencils out on room revenue alone. They're buying something else entirely. A trophy hotel in a global city is a physical, appreciating, difficult-to-replicate asset in a prime location that cannot be built again at any price, because the land underneath it simply doesn't exist anywhere else. It's a hedge against currency risk, a diversification play outside of stocks and bonds, and in many cases, a branded residences component sold to individual buyers funds a huge chunk of the project up front. The exact strategy several major luxury developments are using right now to make impossible construction costs pencil out at all. The hotel operation itself becomes almost secondary to the real estate play sitting underneath it. Let's build a real scenario. Not the best case, not the worst case. A realistic first year for a 200-room luxury hotel built at the industry median. Construction cost at just over $1 million per key puts total development cost around $212 million, land included. Say the ownership group puts down 35% and finances the rest, which puts annual debt service somewhere in the neighborhood of $9 million a year. At an average daily rate of $394 and a healthy luxury occupancy rate of 65%, annual room revenue lands around $18.7 million. Add food, beverage, banquet, and spa revenue, which at a well-run luxury property commonly runs close to total room revenue itself, and total revenue for the year comes in somewhere around $34 million. Subtract operating expenses at a realistic 70% of total revenue for a full-service luxury property, and you're left with a gross operating profit of roughly $10 million. Subtract franchise fees at 11% of room revenue, about $2 million. Subtract property taxes and insurance on a building this size, another $2 to $3 million. What's left to cover that $9 million annual debt payment is thin, sometimes barely enough, sometimes not enough at all in a soft year. This is why so many luxury hotel deals only work with cheap, patient capital, or with a residential sales component subsidizing the construction cost from day one. The two scenarios: the good year, business travel is strong, corporate events are booking a year out, and your banquet calendar is full of weddings every single weekend from May through October. Occupancy hits 70%, average daily rate pushes past $400, and your food and beverage team is running at capacity. Total revenue climbs toward $38 million. Gross operating profit clears $12 million, and after debt service and fees, the ownership group actually pockets a real return, on top of the building itself appreciating in a hot real estate market. The bad year. A regional recession softens corporate travel. Two major conventions relocate to a competing city. Your banquet calendar, normally packed with weddings, has 3 cancellations in a single quarter as couples cut back on spending. Occupancy drops to 52%. Labor costs, which don't scale down as fast as revenue falls, eat a bigger share of every dollar you do collect. Total revenue falls to $26 million, and once debt service, franchise fees, taxes, and insurance are covered, the ownership group is underwater for the year, covering the shortfall out of reserves or a fresh capital call. The swing between those two scenarios can be $8 to $10 million, and almost none of it is inside the owner's control. The people who actually thrive owning luxury hotels are almost never the ones who got lucky with one great summer. They're the ones who diversified revenue beyond rooms, who built a wedding and events calendar that fills the ballroom even when travel slows down, who kept cash reserves large enough to survive a bad 18 months without selling at the bottom, and who understood from day one that they weren't really in the hospitality business. They were in the real estate business, using a hotel operation to service the debt on an appreciating trophy asset in a location nobody can replicate. Which means the answer to whether a luxury hotel can make you rich is yes, it can, but almost never through room revenue on the timeline most new owners imagine. It happens slowly, through land appreciation, brand equity, and the ballroom calendar, while the rooms themselves quietly cover the electric bill. The romance of owning a five-star hotel is real. The economics underneath it are a completely different story, and the owners who last are the ones who learn to hold both truths at the same time.
Before you go, do yourself a favor. Hit that subscribe button. I break down money, investing, and business in the simplest way possible. Join thousands of smart viewers and let's grow together.